Welcome back to Tax UK, the practical tax channel. In today's video, we're looking at disposing of shares and how you should always be considering the 30-day rule at the point of disposal. Now, these rules are sometimes better known as bed and breakfasting rules or share matching rules. You see, in the UK, we actually have a pretty generous capital gains tax system with a large tax-free allowance of £12,300 per tax year, and then capital gains rates that are comparatively low compared to the rest of the world. To take advantage of this, investors will often sell off part of their portfolio at the end of each tax year with the intention of realising a gain around that £12,300 mark in order to utilise their allowance before it resets at the start of the new tax year. In the past, you would have been able to do this without the intention of ever really exiting the market by selling the shares to crystallise the gain and then immediately buying them back to maintain your exposure to the stock market. As you can imagine, HMRC were not particularly impressed by this exercise, as that wasn't what the capital gains tax allowance was intended for, and they created what we now know as share matching rules to discourage investors from using that loophole. So before I run through the rules, it's important to understand the basics of how a capital gain is actually calculated, which, lucky for us, is pretty straightforward. You buy a share for $100, you sell it for $150, leaving you with a $50 gain. But what about where you're making multiple buys before selling part of your holding? Which shares have you actually sold? In this case, you'll need to create what is known as a share pool or a Section 104 holding, meaning that if you buy one share in company Y on the 1st of June for $100 and another share in the same company on the 1st of July for $200, then you have two shares in the Section 104 holding at a total cost of $300 and an average cost per share of $150. If in the following year you then sold one of your shares in company Y for $250, then to determine the acquisition cost, we look to the average price of our Section 104 holding, which would be $150 a share. And in this example, we would have realized a gain of $100. So when you dispose of a share, in the eyes of HMRC, you're not actually selling a specific share, rather you're selling part of your holding, if that makes sense. So in some situations, working out your gain and the pooling of shares isn't too difficult. You can also deduct some related expenses, such as the transaction fees that a brokerage might charge, but on the whole, it's pretty easy up until this point. That is until you repurchase shares of the same class or from the same company within a 30-day period from the date of disposal. Where this is the case, you'll need to match shares in a certain order, and I'm going to switch across to the laptop so I can show you these rules in more detail. This here is the guidance on capital gains tax from HMRC. Gives you a little bit of information about the rules and why they might be needed, how they came about. Gives you a good example here, example 1 of the share matching or the Section 104 holding, that we've just been through, but similar to the example that we've run through, and then gives you the rules. So whenever you dispose of shares, whether it's one share, 100 shares, 1,000 shares, these are the steps that you need to follow in order to identify which shares you're actually matching against. The first step is to match against shares acquired on the same day as the disposal. So this is the same day rule. So if I sell a share in Tesla and then repurchase it on the same day, when I'm calculating my gain, I actually have to use the price that I repurchased that share at as my original acquisition cost, which probably means there's going to be no gain. And that's exactly the intention of these rules. After you've done that, you can move on to step 2. So that would be to match against shares acquired in the 30 days following the day of disposal. This one is known as the bed and breakfasting rule, and it also says providing the person is resident in the UK at the time of acquisition. For non-residents, there'll be slightly different rules to apply, but I think this will apply to the majority of us. So again, if I sell today and repurchase in 21 days time, then I'm actually going to have to use the price that I repurchased at as my original acquisition cost. And that's probably going to mean, again, that I haven't really made much of a gain. And then the third step is to then allocate against shares in the Section 104 holding, which we've already been through. Below the rules, they then have a really good example, so I'll just run through this with you. Mr. Schneider owned 10,000 shares of Mesopotamia PLC. 500 were purchased on the 11th of September. The remaining 9,500 are held in the 104 holding. So that's our pool of shares, and probably means that he's been buying shares across a period of time. Mr. Schneider sells 4,000 shares on the 30th of August. The disposals are identified as. We don't really need the answer, we can work through it. We know that the disposal of 4,000 shares was made on the 30th of August 2020. To work through the rules, did he acquire on the same day of disposal? So did he buy any shares back on the 30th of August? No, per the example. So you can then move on to the second step. Did he acquire shares within 30 days? Yes, in the example you can see he acquired shares on the 11th of September, which is 12 days after. So we'll have to match against those 500 shares first. After that, we then move on to the 104 holding. So the remaining 3,500 shares will be allocated from the section 104 pool. And you can see the answer highlighted at the bottom here. It's pretty straightforward once you're aware of the rules. Now, I don't buy and sell shares on a regular basis. I tend to buy and hold for a long period of time. I can probably tell you off the top of my head whether I've repurchased shares in the same company within a 30-day period, but maybe for someone who's day trading or just buying and selling on a more regular basis, obviously it gets a little bit more complicated, and you need to have a system in place to keep track of this and make sure that you're following those rules. As you can see, things do get a little bit complicated when you're repurchasing within that 30-day window. There are a number of ways around this, the most obvious being to simply wait 31 days before rebuying the shares. The risk here is that the market can move a lot in a 31-day period and you're not maintaining your exposure to it. These rules also only apply when you repurchase shares of the same class. So if I were to sell my share in company Y today and then repurchase a share in company X tomorrow, then I wouldn't be caught by these rules at all, and I'm still maintaining some exposure to the market. And finally, if you are married or in a civil partnership, you can usually transfer assets between yourself and your spouse or civil partner without realizing a gain. So you can use that to your advantage and make the repurchase of a share in your spouse's name before transferring ownership back at a later date. So whether you're actively planning your share disposals to be more tax efficient or just selling a few shares to free up cash, it is important to be aware of these rules and to understand how they might affect you. So I hope you found that useful. Thank you all for watching, and I will see you next time.